Welcome to today's session. This is the first of 5 sessions where we want to help you and work with you through how to plan an audit on caseware. And this session deals with both Probe Audit Premium Plus, if that's your audit methodology, as well as Audit International. In terms of the topics we're going to address, you can see Introduction to Acceptance and Continuance of the Client Relationship and Engagement, Companies Act, ethical considerations, preconditions for an audit, then some specific circumstances to consider, the going concern basis of accounting, or going concern assumption, the engagement partner responsibilities, and then we will go and look at the documents in the Probe or AI methodologies themselves. And we've also included the links there. If you are using Probe Audit, we are going to basically deal with the content of 1020 and 1021 today. And in AI, we are going to deal with 405 and 415. All right, so that's the content that we're going to address today. Right, then by way of an introduction, the session is really, we said now we're going to work with 1020 and 1021, which is the acceptance and continuance. And the important thing here is that, first of all, we're not just considering this once off when we take the client on the first time. We are actually considering whether we want to accept a client or continue the relationship with a client, both for the client initially, and then also every single year to say, do I want to continue my business relationship with the client? And then further, not just for the client itself, but also actually for every engagement. So that's quite important. Do I really want to do the audit for this client, or do I want to do the tax for this client? It's not just a matter of I'm going to continue my relationship with a client, but do I want to do the audit still for this client? Can I still do the audit for the client based on the other work that I've also done for the client this year? And so I can continue. All right, so there are multiple requirements to consider in whether we can accept or continue an engagement, and the documentation really helps us to consider that. But to some degree, you still need to, one, understand what the requirements are, and secondly, sometimes just actually be aware of some of them. All right, it is actually impossible to have all of the requirements in the documents. I was looking at one specific thing this morning and realizing that actually to add another 3 questions is not really going to add value. The fact that we are asking you one question can actually address all 3 of them, as long as you are aware of those requirements. Good. Then the firms will normally have a checklist for acceptance documentation. And also bear in mind that by the time that you've been allocated this audit and you've started the caseware file, probably even imported the trial balance, by this time, the decision to take on this client or to continue the relationship and the engagement has probably already been taken. So if something looks a bit strange, if you're unsure what the answer would be, what the consideration was, speak to the manager and the engagement partner, because they would not necessarily have, almost want to say, let you loose on. It sounds a bit rough, but they almost would not have planned you on this engagement if they had already decided that there is not a reason for us to continue, or there's a very good reason for us specifically to discontinue. So we're just now actually working in the software and documenting probably considerations that were already made before. Right. So the information that was gathered during the process of client acceptance, during the process of deciding to continue this relationship with a client, that's what we're going to document in this process. Good. Then Companies Act. There's a lot of Companies Act considerations in our acceptance process, and we want to just quickly have a look at a few of those points. First of all, the public interest score, and a few points to consider in that regard. We calculate the public interest score. Actually, the client calculates the public interest score, and as the auditors, we use the calculator of the public interest score to basically check that we are doing the correct engagement. We're not allowing the incorrect engagement. So, for example, where we've drafted the financials of a statutory audit, this calculator will help us to ensure that we don't do something that we shouldn't have done. Right. I've specifically included the definitions here for you to say independently compiled and reported means that the annual financial statements are prepared by the independent accounting professional on the basis of the financial records in accordance with relevant financial reporting standards. And then the independent accounting professional is also defined on the slide there. What is important to note here is that financials are not independently compiled and reported on the one side, and on the other side, we are not independent when we are compiling and reporting. There's the flip side to that is actually internally compiled. Okay, so the standard literally says financial statements are internally compiled unless they are independently compiled, and then independently compiled is defined. So only if financial statements have been prepared by an independent accounting professional on the basis of the financial records in accordance with basically IFRS or IFRS 40, only then can you say the financial statements are independently compiled. It's not to be compiled by an independent auditor. That's not the definition. Okay, so this is just the point I wanted to make here in terms of considering whether it is independently compiled and reported. And that, of course, is one of the points to consider whether an audit is required or not. Right, next then is the independence requirements that is included in the Companies Act. Right, so maybe something, if you were wondering, oh my word, why must I sit through this thing now this afternoon? It's Friday, whatever the reasons are, here is something for you to take away. If you get nothing else from today's session, this is good news. So the Companies Act was recently amended. And one of the big things that we've literally been waiting, I almost want to say begging for, since 2010, yes, you heard right, okay, 15 years, is actually that we no longer have the 5-year requirement for independence, where a financial statements company has, sorry, let me start that sentence again. Where the Companies Act has the requirement, or previously had the requirement, that where a client had actually prepared the financial statements of a statutory audit and then had to not prepare the financial statements for 5 years. Okay, you had to basically cool down for 5 years before you could become the auditor. That has now come down to only 2 years. So yes, you are still not allowed to be a director or prescribed officer to be the auditor, or an employee, and so on and so on. But if you were any of those at any time during the previous, then it is 2 financial years immediately preceding the date of appointment, no longer 5. Okay, so that is at least a little bit of good news. I'm getting a comment here about referring to the local Botswana Companies Act. Yes, okay, so the point there is when you set up your firm template, you would need to set up your firm template to say that if your firm is in Botswana or in Ghana or wherever you are, you need to set up your file to say that you are in that jurisdiction. And then the requirements will reflect to those relevant points. Now, the South African Companies Act has a lot of independence requirements very specifically. I myself do not know what the Botswana Companies Act requirements are. So if there is something similar to independence requirements, then you would have to, yes, refer to that act to consider it in order to answer the questions. If there is no independence, well, then you can also just, if it doesn't pop up at all, then maybe that's been appropriately mapped. Or if it does pop up and ask you about that, yes, then refer and maybe then say, no, there is no such independence requirements. Or, of course, if it is, then you just allocate that. Yes, correctly so. The South African Companies Act has rotation requirements. So maybe I should also just mention the previous point that we were looking at is section 90, subsection 2. The one we're looking at now is subsection 92, okay, as in 2 plus 90. So section 92 has rotation requirements. Section 90, subsection 2 has independence requirements. Okay, those two can get confusing if you don't either speak clearly or listen clearly. Good. So the rotation requirement says if the auditor has been the auditor for 5 consecutive years, he has to basically cool down for 2 years. And I suspect that it's those 2 years of cool down that's now also been brought in, or then basically aligned to when you did, let's call it then, disallowed services. Okay. In the case of a client being a public interest entity, either your local professional code of professional conduct or the ISBA code, or in a South African environment, the IRBA code of professional conduct, then also contains additional or further requirements for the auditor to meet in terms of rotation, well, and for that matter, even independence, if you okay. There could also be other legislations, industry, etc., that is applicable for familiarity. And also, even the ISBA code talks about long association. So the South African Companies Act, for example, talks very specifically about the engagement partner that has to rotate and the key engagement partner. And even the code talks about a variety of people, the engagement quality reviewer and things like that. But it does also talk about long association of almost want to say people that aren't partners. So if your audit manager has been the manager for 7 years, well, then maybe you also need to consider whether there could be a familiarity threat or whether there's a risk due to long association. So also consider your firm's policies in terms of quality management, consider the ethical requirements, etc., for possible rotation requirements. Then in terms of ethical requirements, let's do a poll and see what do you think. Yeah. So the poll that I want to ask you is basically to say which of the following examples is not a threat to the fundamental principles. So I'm not going to lecture you on the fundamental principles. I just want to know which of these 4 items that I'm listing is not a fundamental principle in terms of the code of conduct, and that's either the RBA or the IASPA code of conduct. So you can just fill in on the poll which of these are not considered to be a threat in terms of the fundamental principles of the code of conduct. I've only got about 7% of people voted, so I'd really like it if I can get a few more votes in, please. Okay, so you are happily voting away. I'm going to stop the poll now because I can see we are clearly moving in a very specific direction. So get your last votes in now, and then we will move along. Okay. So look at that, how very interesting. So absolutely correct. Independence is not one of the threats from the fundamental principles. Independence is an additional point of, well, in fact, there are independence standards in terms of the Code of Professional Conduct. So the Code of Conduct stipulates that there are 5 principles, fundamental principles. Fundamental principles are objectivity, confidentiality, professional competence and due care, things like that. Then there are the threats, which are your self-review, self-interest, advocacy, familiarity, and now for the life of me, I'm forgetting the last one. And then after all of those requirements around the fundamental principles, we also have the independence standards. And so independence, therefore, is not a threat from the list here. Okay, so advocacy, yes, advocacy can be a threat to fundamental principles, but independence is a whole extra list of requirements that, even though independence is very close to objectivity, it is not exactly the same. It's not equated to each other in the Code of Conduct. All right, thank you for your participation there. Good, so just to confirm, oh, there we go. I forgot I had it in the slide. So we've got intimidation. Of course, that's the one I forgot. So if I had to now complete a list, what are the types of threats? Oh my word, I would have forgotten intimidation. Eh? So our fundamental principles, integrity, objectivity, professional competence and due care, professional behavior, and then confidentiality, and the types of threats. So independence is an additional list of requirements to comply with. Let me just get back there. There we go. All right, additional ethics considerations other than just the fundamental principles that we need to consider is, again, if the entity is a public interest entity, then there are additional ethical considerations. There are additional things that the auditor may not do or must do or should do, additional communication and so forth. So that is quite important to be aware of if your client is a public interest entity. And then also in terms of the code, I've mentioned then rotation requirements where they are applicable. Then also, before we can decide or confirm that we can accept this engagement of an audit, we need to consider whether the preconditions for an audit is actually present. So those requirements involve 3 things, of which the first item is the factors that, is to consider whether the financial reporting framework that the client uses is acceptable, basically to have an audit done to or on it, depending on how you consider it. So the factors that we need to consider whether the financial reporting framework is acceptable are things such as the nature of the entity, the purpose of the financial statements, and then very important, the requirements of the law or regulation. There's no point in preparing financial statements in terms of IFRS for SME if the legislation requires a completely different financial reporting framework, maybe, I don't know, cash basis or something, okay, whatever the case may be. And then also whether the framework caters to the specific needs of the single biggest investor. No, that is wrong. That is not the case. Okay, so what are we considering for? What are the factors we consider? Well, we are considering the nature of the entity, the purpose of the financial statements, and the requirements of law and regulation. Okay, not the biggest investor. Sorry, I had a poll for this one and I forgot to ask you. So obviously I've had a long morning. Those of you that didn't join this morning, we already had 3 hours of audit level 1, and now we're into audit level 2. So I forgot that this one was a poll. So the poll, what is the correct question? The correct question is, when we consider whether the financial reporting framework is acceptable, we consider the nature of the entity, the purpose of the financials, and the requirements of the law and regulation. Okay. Then that was one of the points that we consider in terms of the preconditions of an auditor. The other conditions that we need to consider whether they are present for the auditor is, first of all, as we said now, whether the financial reporting framework is acceptable. Now, just another thought on that is that we consider the users of the financial statements to determine whether the financial reporting framework is acceptable. But also a part of that is when the financial reporting framework, such as an IFRS or IFRS for SME, is used, those are so-called general purpose financial reporting frameworks. So those are frameworks that are preparing information for general use. There's no specific one individual user, like we mentioned now in the poll question, for the single biggest investor or something like that. There are also instances, more specifically, when legislation requires specific frameworks to be used, which are often more compliance frameworks. So they will then be specifically prepared for very specific users. Okay. So, for example, if I think in a South African environment where the legal practitioner prepares for specific accounts to meet the requirements of the Legal Professions Council, that is a very specific requirement by a very specific user, the Legal Professions Council, and they have a compliance framework by which the trust accounts must be prepared. All right. So that is just also to take into account whether it is a general purpose or general purpose or a compliance framework. A general purpose is also often, not always, a fair presentation. And fair presentation as opposed to compliance, fair presentation means that when you comply with the rules and the, let's call it the principles or the objectives of the requirements, you will achieve fair presentation. So if the requirements do not achieve fair presentation, you can almost want to say, it's very dangerous to say that, but you can almost do what's necessary to get to fair presentation. Obviously, you'll explain and disclose and all of that. The flip side to that is with specific or compliance purpose or compliance frameworks. Compliance framework says you shall do this, you must do this. There's no fair presentation, you must do this. If you do this, you comply. If you don't do this, you're not complying. Okay, so that's fairly simple. All right, then next up, that's the financial reporting framework. Is that acceptable for an audit? We can only audit general purpose or compliance framework, financial statements, financial reporting rather. Then the second point is that management must acknowledge and understand their responsibility for preparing the financials. They've got the responsibility. So even if they don't do that themselves, they still have the responsibility. For preparing the financials, for ensuring internal control, and specifically around the preparation of the financial statements, and for providing access to the information that we require, and of course the persons as well. If they don't take that responsibility, then we don't have what is necessary before we start the audit. The preconditions for the audit are not present. Okay. Next up is that management or those charged with governance must not impose a scope limitation that will result in a disclaimer of opinion. In other words, I can't say you can audit what you need to, but you're not allowed to go in my storeroom. You're not allowed to speak to the FD, things like that. Okay. So that is important as well. Okay, we've mentioned those. Next up then, also still in terms of the financial reporting framework, there could be instances where the financial reporting framework is supplemented. In other words, there are additional requirements by the laws or regulation. The example there is probably something like the Companies Act. What does the Companies Act ask or require in addition to the framework, the IFRS or IFRS for SME? Well, one example maybe is to say directors' remuneration needs to be disclosed. Okay, so that could be something there. Also then an instance where the financial reporting framework is prescribed by law or regulation. Now, it's obviously easy if the prescription is for IFRS or for IFRS for SME, but there are certain points that we need to follow to see, is that an acceptable framework? If it's not acceptable, what do we do? If it is acceptable, how do we go about it, right? So we also need to consider that. And then lastly, when the audit report is prescribed by law or regulation. And there, probably the best example I could think of was something like the Sectional Title Schemes Management Act, where the report and what needs to be reported on is prescribed by legislation. So I'm not going to read everything for you. I trust that you can read it, but those kind of things are everything that we need to consider in terms of determining whether we can, in fact, accept the engagement, whether the financial reporting framework is acceptable. I want to just quickly have a look here. There's a question that says, can the auditor remain partner of an engagement for longer than 5 years if they make use of an independent engagement reviewer? In other words, if there is a second partner that reviews almost like an engagement quality reviewer, or a second partner, it's a very difficult question just to answer in passing. If it is a public interest entity audit, or in a South African context, if it is a South African statutory audit, then no, then the requirements are very specific. You need to actually rotate. So you can't skip rotation by adding an independence review. Okay, by adding an engagement quality reviewer or an independent review, something like that. So when there needs to be rotation, there is rotation. Okay. Good. Back to our financial reporting framework. Then after we've then determined that the 3 preconditions are in fact present, that's when we need to go and get an agreement in terms for the audit engagements. In other words, an engagement letter. If the law or regulation prescribes the terms of the engagement in sufficient detail, we don't need to get a letter in writing. But otherwise, we need that engagement letter in writing. Right. There are some specifics of what needs to be included in there. You can see that the standard is ISO 210, and there's also an example engagement letter included in the standard as well as in the methodology. If there are requests to change the terms of the engagement, it needs to be reasonably justifiable, especially if we think about things like let's say, for example, the client has an audit and you're asking a lot of questions, and then they say, hang on, I'd rather want to have an independent review. Why? Are they trying to hide something, or what's going to happen? So you're not just changing terms of the engagement just for the fun of it. Well, obviously not for the fun, but you've got to consider whether it really is justifiable that a client wants to change an engagement type or change the terms of an engagement. Then the reissuing of engagement letters, there's nothing that says you must have a new engagement letter every year, but when the terms of engagement changes, you need a new engagement letter. So for example, personally, I feel quite strongly that when the allocated engagement partner changes, the key engagement partner, that you should ideally issue a new engagement letter, because that is then signed by the new partner. So automatically you have your latest terms and conditions, you have proof that you've communicated with the client that the partner changes. So you'll preferably change it often enough, but you don't have to do it every year. And of course, when the terms change. Okay. The documents included in the methodology for Probe Audit, that is 1021 that you will use to document this, whereas Audit International, you will use 415 to document your engagement letter, or as the template for your engagement letter. Okay. Then let's consider a few specific matters. First of all, key audit matters. So ISO 701 requires that the auditor has to, very specifically for listed entities, or as is the new term, publicly traded entities, has to disclose key audit matters. In South Africa, public interest entities must also disclose key audit matters in terms of the new requirements, but it's not statutory audit. So it's nothing to do with public interest score clients. It's public interest entities into the definitions of the code. Have to report key audit matters. So this is really just an additional explanation of the significant areas of the audit. So how does this basically work? It's almost like a funnel. So you take all the items that are reported to management and you determine which of those items reported to management are sufficiently important that it actually warrants a disclosure in the audit report to those reading the audit report to say what are those matters that you had to specifically consider, the key important, critical, key matters from the audit. All right. And then specifically to say what was the issue and what was done about that. All right. The auditor can voluntarily disclose key audit matters, but that's obviously voluntary. Yeah, I personally just think I would not be brave enough to disclose those voluntarily. But if you want to, of course. There's also, just as a very, very quick side note, there's considerations of possibly disclosing going concern, I think going concern, and also possibly having going concern is a key audit matter if it is there's uncertainty about going concern, but it has its own heading now. It's only heading in the audit report, and in the draft considerations about going concern and fraud, they're also thinking about maybe expanding on those. Let's call them special key audit matter paragraphs, but that's now probably on another side note. But key audit matters, we need to consider if we have to report them. And if we have to report them, of course, from the start, we'll be alert to what possibly needs to be reported. Good, then initial audit engagements. Those are the ones where we are auditing for the first time or auditing this client for the first time. In those cases, we need to communicate with a predecessor auditor, so the previous auditor. Right? We have to perform opening balance procedures to check that we can rely on those opening balances, check that we have enough audit evidence or are comfortable that there's been enough work done to confirm the opening balances. Opening balances for this year is, of course, the comparatives for the prior year, right? The standard also says you need to read the latest financial statements for the relevant information and evaluate the previous year's audit opinion. So it is important that when we are doing an audit for the first time, basically taking on a client from another auditor, that we meet the requirements of ISA 510. Okay, and the best time to consider that is as part of the acceptance process. Then perhaps a step that could easily be forgotten about is to consider the previous year's audit report and very specifically the report to management from the previous year. What are we considering here? We are considering the continuing effect of those points. So let's say, for example, there was a qualification last year in the audit report, or there was a point in the report to management last year that indicated the filing wasn't done orderly, and so it was actually resulting in incorrect reporting or incomplete reporting, things like that. What's the impact of that on this year's audit? Well, it's possible that that could still have been going on this year and that we can expect the same issues this year. It's possible that it could have led to more errors this year. It's possible that the client fixed it this year, which would be great. Then we will have less problems, but at the same time, we also need to consider whether last year's problem had any impact on this year. And also, it helps us to consider whether there is a risk of material misstatement for any of those. So quite important for us to consider the audit opinion from last year. If there was a qualification, does that impact the opening balance and to what degree? And then, as we mentioned, the items to report or that were reported to management the previous year. All right, so I want us to actually now do an exercise for the report to management to go and consider a few examples. If you have not done so yet, please go to the materials section. In the materials section, you will find there are two documents. Let me show you what that looks like. I'm really just doing a screenshot here, so it's a little bit rough, but in the materials section you will see that the slides for today is there, okay, as we mentioned earlier, and then also the report to management items. It's just an Excel sheet. Just download that one. At the bottom we're going to quickly just have a look at some of those points there and then just discuss how I would consider those. And when you open that RTM, this is what it's going to look like. I'm actually just going to increase the size of mine slightly. Right. Good. So let's continue. Let's see. So remember now, if we are considering the points on last year's report to management, we are considering whether that will have an impact on this year's numbers, essentially, as well as whether there's a possibility that that could have an impact on what happened this year. So if, for example, let's see the credit notes, so there are 3 credit notes, let's say credit note 5, 6, and 7, or whatever the numbers are that you want to imagine, those 3 credit notes that amounted to a certain amount, okay, not a material amount, okay, so that's why they were fine, were passed after year end last year. So in other words, in this financial year, those credit notes were passed, but they related to the revenue from the previous year. But because they were not material, we did not provide for those credit notes. In other words, they did not actually write back or reverse the sales from the previous year. Because they didn't reverse the sales from the previous year, they did not. The revenue was still reflected last year, and of course, what happened in this year? This year, the revenue actually was reduced. Okay, there was actually less revenue reflected this year because the less revenue this year because, well, the revenue was in the previous year. I still see some people asking about the documents. The documents have been uploaded to this app. Yes, so you look in this app for the materials. Let me maybe share this like that. Then for people still struggling, they can hopefully find it there. And then we can just do this for the material. Okay. Good. So that's if you're looking for the material, you go to materials, top right-hand corner. So I am on the phone. Sorry, not on my phone. I'm on my laptop, on the app on my laptop. So not the, if you're working on your phone, you really are going to struggle to probably see it. It will be there as well. But the phones, that I saw it this morning also. You can see it on the phone app, but then you're going to struggle to work on it possibly. On the app on your laptop, it is there where the screenshot is reflected. Oh. Good. If you can't see it now, we can always get it to you later on. Let's move on to seeing what is in there. This is the only exercise where you're going to need the downloaded material for today, so that shouldn't be a problem. Right, so what's the impact then for this? So first of all, if it's not material, if it wasn't material in the previous year, that's great. One would obviously have to consider whether the impact on this year is still not material. If it wasn't material last year and it's not material this year, then that can still remain an unadjusted audit difference from last year and probably then also in this year. You'll have to bring it into this year to show that there's that unadjusted difference, to know that the cumulative changes on sales is not too big. What you would have to consider, though, is you would have to think whether this same problem could occur this year. So we have a 30 April year end. So if last year, 30 April, this was the issue, did it perhaps happen this year as well? All right, that's the first one. Does this impact my current year audit? Yes, I need to consider the impact on opening balances and whether there is a cut-off error in this year. Okay, let me just make the cell slightly smaller. There we go. And that's then all there. Good. Next question. There was an amount of unrecorded payables, unrecorded trade payables, creditors, something, to the amount that was identified during the audit. So again, because it was in the report to management, it was not material. We added it to the list of unrecorded liabilities, so not material item. How did we pick this up? Well, probably as part of our search for unrecorded liabilities, which is probably checking the bank statements after year end and seeing what it related to, and then saying, oh man, this was actually a creditor that had to be raised at year end. Wasn't raised at year end. What is the impact of that this year? Well, it was raised at the beginning of this year, but it was then obviously paid off as well. Okay, hopefully. We'll check if that was paid off. But the possibility is that this year there could again be unrecorded liabilities. So consider a risk for the current year of unrecorded liabilities. Right. Of course, they've been paid off, guys. I'm making my own jokes here, but that's just silliness. So, of course, it's been paid off because you picked up the payment from the bank statement. So, of course, it's been paid off. Next up, not all journal entries were appropriately authorized during the year. Right. So, This obviously raises a concern because people, users of the accounting software, are processing journal entries which have not been appropriately authorized. That could definitely lead to problems for us. However, remember that we already have the risk, fraud risk, the statutory fraud risk, that not statutory, the required prescribed fraud risk that we have to consider the possibility of management overriding control. So we already have that risk, and with that risk, what are we doing? We're already testing journal entries. We're already testing if journal entries are appropriately authorized. We are already checking or inspecting supporting documentation for those journal entries to see if they are supported by legitimate, valid documentation. So yes, it does impact my current year audit in the sense that I'm going to have to go and test for it. But at the same time, also, I guess one could say, well, I'm not really going to do more than I would have otherwise because I'm already considering a risk of material misstatement, a risk of management overriding controls. I'm already doing that. Okay, so I want to now say usual. I wanted to say normal, but I'm going to say usual journal entry testing for management override will be done or will be performed. But one can then also, in selecting your items, perhaps consider if it is necessary to select more journal entries to test validity of the entries. Okay, let me just wrap that. So, why am I not seeing? There we go. Okay, the last point is the financial statements last year were not issued within 6 months of the year end. Now, because we've got people from outside of South Africa as well, in the South African context, the legislation says a company must have their financial statements drafted, compiled, prepared, finalized, call it what you want, audited within 6 months after the year end. Okay, so the audited, strictly speaking, is not required, but because we know that as part of the audit, the financials are often finalized towards the end only, that kind of brings it in. Okay, so don't think that I'm saying it must be audited. I know there's that whole debate around it, but practically speaking, if the financials are not compiled yet, if they're not finalized yet, and we're doing the audit now and we know it's still going to be adjusted, then the audit financials have not been completed yet. So last year, the financials were only completed after 6 months after year end. So last year, there was an issue, okay? In last year's file, we would have, let's say, we did document our considerations for whether that was a report with irregularity in terms of the Companies Act requirements, which is non-compliance with laws or regulation, which is in terms of the South African Auditing Practice Act. Okay. Now, what does this tell us about the current year? In the current year, this has an impact. We have to consider what the impact is for this year. So last year, the financials weren't done, that's done and dusted, but what about this year? So there's one of two options. Firstly, if it is not yet 6 months after year end, okay, we can say, well, this year we are still compliant. And hopefully we will get it done within the 6 months, and that's all fine. But we'll be alerted. Maybe also to say, why did it happen last year? Why did it take so long? Okay, was it because the directors were traveling and all those things and whatever the case is? That's actually not even an excuse these days anymore. You can sign electronically, so you don't actually all need to be in the same room anymore. Right. So if not yet 6 months, but if it has already been 6 months, okay, it's already been 6 months since the year end. What then? Well, then we're already into an issue, and then we need to document our considerations of whether this is a report with irregularity or not. The fact that the client has, again, not done this within 6 months. My little sermon for the day is that ideally a firm should have a system by which they can pick up from their clients and from their year ends the moment that they go over 6 months and be able to actually then already document the report with irregularity considerations and do the reporting as and when that occurs. It's easy to do that. You've got your system, your practice management software, you know who your clients are, you know what their financial year ends are. So the moment that happens that you've got 6 months since the last financial period in, that's that time. So it's not difficult to actually get that done anymore. The trick is one needs to actually just monitor that. Good, that was my little sermon there. Next up then, we've got going concern. We're going to take a break soon, so don't worry. I know it's late in the day. In terms of going concern, there's a lot of theory about going concern, but the important thing is that one needs to be alert to and look out for events or conditions that are identified that indicates that there may be a possibility that the client is not going to be a going concern or cannot continue to operate as a going concern. Right. What does the standard say? Management has the first responsibility. They must do an assessment, and we will simply evaluate their assessment. The standard for going concern has been redrafted, and the effective date for the new standard is for financial periods beginning on or after 15 December 2026, which basically means that the first time you're going to use that new standard is only basically for a 6-month period ending 30 June 2027. Okay, that's like 2.5 years down the line. So we're still using the old standard, still considering for a period of minimum of 12 months and considering the relevant information. And then when management did not make an assessment, we are going to discuss with them their basis of continuing the use of a going concern basis of accounting in preparing the financial statements, ask about events or conditions, and importantly, remain alert to any possible events and conditions throughout the period. All right. I see a question there. Does the risk of non-compliance still exist after year end? Could you please just expand on that question? I'm not entirely sure what you are referring to in that regard. Thank you. Good. So going concern, it is a big thing for us to consider. Make sure that you are aware of the requirements in the going concern standard so that you can consider that. This is just a list of all the examples of possible events or conditions. Not all of them, but from the standard, of course, there are always more examples as well. Good. Engagement partner responsibilities. The ISO 220 revised that we implemented with the change in the quality management standards has an extensive list of requirements for the engagement partner. It's not that there never were any requirements, they've just really expanded on it, clarified, added additional requirements. But it really is about saying that the engagement partner, you see the superhero there in the little circle, he or she is the superhero, ultimately responsible for ensuring the quality on the engagement, ensuring the firm's culture and the expected behavior is applied in this engagement. And they must be sufficiently and appropriately involved throughout the audit. So from the get-go, they need to be involved in this engagement. Take action when there are ethical threats that arise, and ensure that all the firm's policies and procedures in terms of, I want to say in terms of quality management, in terms of compliance with the standards, etc., is actually followed. Okay, and then if an engagement quality review is required, again, in terms of the firm's policies and procedures, that engagement partner must ensure that the EQR is appointed and that all the requirements in terms of the ISQN2 is also followed. Right. Again, I see the question in terms of the non-compliance. If the financials are signed off after 6 months, does the risk of non-compliance still exist? I'm sorry, I still don't understand what the question is, so you might have to just give me some more information there, please. Good. So we are almost at our comfort break and then at our breakout session. So let's just quickly see what we're going to do coming up. So today we are going to now go and look at the documents in our methodologies, and we're going to see how all of these considerations from the engagement, acceptance, and continuance is going to actually play out. What is it going to look like on the documents? But then our next sessions, and you can see there are another 4 sessions. They are all 3 hours long, but the good news is they are in the mornings, right? And we are going to then continue this planning of the section. So we're not done yet. Just before we break up into our separate sections, I wanted to just confirm. So on the 21st of February, that's next Friday morning, we will continue with understanding the entity and considering where there may be risks that we identify there. On the 14th of March, we will consider the risk assessment at the overall level, so financial statement level, inherent risk, fraud risk, things like that. And then in our last 2 sessions, we are going to do, for specific account balances or classes of transactions, we are going to do risk assessment and follow the whole planning process through from understanding that account, doing the risk assessment, planning the response to the work program, so that we can really see how that all flows through in the planning documents for a few of the classes of transactions.